Hello there folks, so today we're doing the consolidated P&L. So the question that you'll need to start off with is the one called PAC and SAC Limited. So if you want to pause the video at any point whilst you need to get anything or copy anything down, please do so. Okay, so we're doing the consolidated P&L, which is our last bit of input. The same principle as the SFP. So as you can see here, we've got two companies, so PAC Limited, SAC Limited, and we've got two P&Ls for each. So we've got two P&Ls, one for each company. Standard P&L, revenue minus cost of sales gives gross profit, minus our expenses to give profit before tax, minus the tax profit for the year. So two standard P&Ls, but what we're doing with consolidation is gluing those together. Okay, so for the consolidated P&L, there are four things that we have to think about. So you can call these four workings, or you can just think of these as four things you need to think about. I don't mind, but these four things are the following. Okay, so number one is the group structure. So just like when we did the SFP, you need to think about, do we have an NCI? Because if we do, we need to consider them because some of the profit will belong to them. Working two is going to be do we have any intercompany transactions? Okay. This could be things like, have we sold goods to each other? Have we paid dividends to each other? Have we perhaps loaned money and paid interest to each other? Okay, but remember folks, we're taking two companies and making them into one for consolidation. So you can't lend yourself money, you can't pay yourself a dividend, you can't sell goods to yourself. So that's why when we're doing intercompany transactions, we've got to remove them on consolidation. The third thing then that we need to think about is, do we have any unrealised profit again? So we did this in the SFP, and this is going to affect the same place again. So in the SFP affected closing inventory, it's going to affect the same in the P&L because remember the closing inventory lives in the cost of sales. So we need to think about that again. And then the last thing that we need to think about, which is number 4, is the profit share. So if we've got an NCI in working 1, we've then got to work out, well, how much of the profit belongs to the NCI. Okay, so those are the 4 things that you need to be making yourself aware of. So if you need to, pause while you copy those down. Okay, so let's go to our example for today for this first one. So this is the summary statement of PAC Limited, the parent company, and SAC Limited, its subsidiary, for the year ending the 31st of December 2018. PAC Limited bought 80% of the shares of SAC Limited on the 1st of January 2006. Okay, so straight away there, we've been told that they bought 80%. So we know for our working 1 that we have 80% ownership, which means we have an NCI of 20%. So 80% was bought, which means, yes, we do have an NCI of 20%. Okay. Then, when we look down our P&L then, if you have a quick read through, you will see that there is no intercompany transactions. So we've not got any intercompany transactions to adjust for. And because there's no intercompany transactions, that also means that there's no unrealised profit. So I can tick off that I've looked at number 2, but I can say no, there's no intercompany transactions. And number 3, because there's no intercompany transactions, there's also no unrealised profit. So far I've thought of factor 1, 2 and 3. I'm going to come back to number 4 when we've done our P&L. Okay. So for this one then, folks, it's really, really simple. We are literally going to take every line, just like with the SFP, use these lines to guide you, and we're going to add them together. So revenue, it's going to be 115 plus the 60 to give me a new revenue of 175. Cost of sales is going to be 65 plus the 28 to give me 93, to give me a gross profit now of 82. Distribution, now 13. Admin, now 27, to give me a profit before tax of 42. Tax to come off of 10, to give me a profit for the year of 32. Okay. Now, this is where working for comes in, because as you can see, we've got a profit for the year of 32. So our consolidated P&L says we have a profit of 32. What you've now got to do is take that 32 and split it out. So as you can see here, I've got a section called attributable to. So this is how much of that 32 belongs to the parent, and how much of that 32 belongs to the NCI. What we know is this has got to equal 32 because this has got to match this, okay? So some people work out both of these. Some people work out one and then put the other one in as a balancing figure. I don't really mind as long as you get it right. Okay. So, how do we split it out? Well, this one's very simple, but we want to just get in the gist of what we do. So, if I was to look at this P&L, can you see that the parent has made 22,000 and the subsidiary has made 10,000, giving us our 32? The parent is entitled to their full 22,000. So that 22 belongs to the parent. The 10 though, 20% belongs to the NCI, which would be 2. And 80% belongs to the parent, which is 8. So therefore, in this example, the parent has got their 22 plus the 8 from the subsidiary to give 30. And the NCI, as we've already said, is entitled to 2, which gives you your 2. So that is, folks, your first consolidated P&L. What I would like you to do now, folks, is to get the other question, which is called J. No, not that one. Oh, gosh, you won't like that if you did that now. This one here that's called Casa and Rowell. This again is a basic one. I would like you to do your workings 1 to 4, check your 4 things, and do your consolidated statement and split out the profit. And if you want to pause the video now, because in a minute I'm going to put the answer on the screen. So pause now, do your question, and then come back for the answer.